We are officially at start time. It's 1:45 here. So, Jeff, I think maybe best to just give a little introduction to yourself in case anyone doesn't know who you are, and then we can kind of get into the presentation.
For those who don't know me, my dad was a gold prospector. He did not work for a company. He worked on his own with a group of guys. Did it for, oh geez, 20 years or so until he just got a little too old to do it. His biggest find was actually a giant 5 pound piece of quartz, and it had about 3.5 ounces of gold running through it. It was beautiful. And then I worked at Casey Research for a while, for many years actually. For those that know that company, it's a different company now. But then I worked for a couple different bullion dealers, other newsletter writers, and I decided I wanted to start a free service. What we have is the Gold Advisor for people who wanted to learn more about the industry. And I got roped into starting a paid letter again. And then I went out and bought a competitor. So we always talk about M&A in the mining sector. Well, we did some M&A in the newsletter sector. So when Callie approached me about this event and wanted it to be educational, what I want to talk about is the fact that the junior mining sector is one of the very last bastions of capitalism where you can essentially be your own venture capitalist. That happens very few other places. And so I want to talk about how you can spot high potential junior mining stocks in this presentation. So as it says there, junior mining allows retail investors to speculate like a venture capitalist. There's very few places in the world where you can still do this and still get consistent returns. Not every single one will be a winner, but you can be consistent about it. Doubles and triples and more are common. As it says there, I hit my first 20 bagger last month. It's now a 21 bagger. So this kind of thing can happen. And by the way, I bought it in the middle of COVID. So it has, took less than 5 years, and that's what happened. Spectacular returns are usually reserved for private venture capitalists. That's really true. It's really you've heard the saying, the rich get richer. Well, that's really true with private venture capitalists because they will invest in opportunities that you and I would not normally have access to. But you can do the same thing in junior mining. They are high risk. Junior mining stocks are high risk. They will not all be winners, like I said. So you have to take a Pringles approach. You can't eat just one and you can't just buy one. So you have to buy a basket of these things if you're going to speculate in this sector. So first of all, I think it's important to note that the metals markets have have turned decisively bullish, which means it's time to invest right now. So there, as you can see, the gold price was up 65% since the bull market began 15 months ago. The chart on the right shows, I don't know if our window's blocking that or not, but the chart on the right shows that gold is up 65% since February 28th. And why that date? Well, the next day was leap year day that year. And the day before, on February 28th, after the market closed, the Fed came out and said, hey, we're going to lower rates more quickly and more often than we thought. Now that's since changed, but at that point, the gold price ignited. And the key point is it never really looked back. It's up 65% just since that date. And then look at GDX. For those who don't know, that's the gold miners index. It's doubled. And GDXJ on the far right, that's the Junior miners index, it's up over 121% since that date. So as it says there on the left, we have a bullish environment. First of all, the highest quality miners are moving. GDXJ has more than doubled. You want to see the miners outperforming the metal, not just with gold, but with all metals, because you want them to have that leverage to the metal, right? So that's what you want to see. And then you want to see the junior miners outperforming the bigger indexes. And that's exactly what's happening right now. So that tells me, that alone tells me, look, this is a bull market. I've been saying this for a while now. So you have to be long. Number two, it's important to note that the reason some of these stocks have really started to move is the sellers are mostly gone. So for those of you who've been in the market a while, you know that for, oh geez, 3, 4 years after the big COVID bounce, that this market has been really depressed. But all of a sudden, about a year ago, it really started to ignite. That's because most sellers have sold, they're out, they're gone. And now you have fund managers, institutional investors, et cetera, that are buying into these stocks. And number three, it's important to note we've just seen this year, a little bit last year. The amount that is being poured into financings, private placements, has really jumped significantly. This clearly shows there's strong interest in these stocks right now. Companies that used to raise 1 million now are raising 3. Those that could raise 3 before, now they're raising 5. So we have a lot of institutional interest in these stocks, and that's why some of them are really moving. Okay, so that was gold. Let's talk about silver real quickly. And I know Peter covered a lot about silver yesterday, but there's one thing I want to point out, and that's number one there. Silver lags in the beginning of a bull market, gold leads. And then before the bull market is over, what typically happens is that reverses and silver leads. And even though gold is rising, it doesn't rise as much as silver. So therefore, by the end of the bull market, you have silver outperforming gold. And that's what you see in the chart on the right there. You see times where gold has risen multiple times, but silver in the orange actually rose more. And so that's one thing you want to be aware of is if you're in some silver now, it's not risen as much as gold, but don't be discouraged by that. Number two, the gold silver ratio, which is simply the gold price divided by the silver price, that favors silver right now. It's definitely undervalued relative to the gold price. And number three, there's a very strong opportunity with the equities right now. Some have moved, some have not yet, not as much as gold. So that opportunity is right in front of us, in my opinion. The uranium market, number one there, spot prices have resumed an uptrend. You can see there on the chart on the right that the uranium price, the spot price, was in a pretty significant downtrend until a couple months ago. Now it's resumed its uptrend. So uranium is turning more bullish. Number two, uranium has strong political support. I'm sure many of you heard that Trump just made uranium a critical mineral. He listed those and he named uranium specifically. So there's going to be strong political backing for it. There's strong environmental backing because it releases zero carbons. Number three, there's a supply deficit versus growing demand, especially North America. You probably have heard that we don't have a lot of uranium production in the US. There's some in Canada, but it's not sufficient. So there will be demand for high quality uranium projects and mines going forward, simply because of political support, but also because there's not enough supply and there's going to be too much demand for it. Number four, the equities are starting to move. This is just recent since that bounce you can see there in maybe April when it started. So it's not too late to invest in this market. Okay, the copper market, as it says there, number one, supply is rising this year. Supply is actually going to be higher this year than last year. Many were predicting that supply was going to crash and all that, and it's going to uh, uh, reduce very soon. But this year, it's actually going to be higher. But that demand in 1 to 2 years is not going to be met if we continue on the trajectory that we're at now. We need more high quality copper mines in North America. Copper is part of the energy transition, so that means it's a long-term investment. And number three, new discoveries and resource growth will be rewarded. The reason I point that out is because of the chart at the right. Copper has never risen during a recession, going all the way back to the 60s. You can see there, I documented the copper price performance during each recession. Now, the one thing to keep in mind, though, is so if you're worried about a recession, that's one thing to be aware of, right? The one thing to keep in mind, though, is we're not investing in copper per se. We're investing in mining projects that can either make a discovery or prove up a resource or significantly grow the resource. The market will reward those activities. And so that's what you want to be aware of. Critical minerals, this is lithium, nickel, the REE market. There are vulnerable supply chains right now globally. And you can see on the chart on the right that China dominates this market right now. China is the red dots, the US is the yellow dots. They tend to have a lot more um, projects that are in development, much more than the US. Um, China controls that market. There's a lot of catching up to do in North America. And the thing to be aware of is there's going to be faster permitting now in North America, not just in the US, but, um, oops, get rid of that. Not just in the US, but in Canada as well. There's spillover there. There's already some leaders in Canada that are already starting to say they're going to reduce permitting times, and this is going to benefit all the critical minerals, lithium, nickel, rare earth elements, etc. And it won't go to the next slide. There we go. Okay, so investing in junior mining requires a different approach than if you're going to buy Apple or Amazon or Microsoft or Google or any of those, right? Because when you're looking at those companies, you're looking at, okay, what is their profitability and what's their growth like? What they have new products coming out? Are they going to grow a lot? Are their earnings going to go up? Those are key things for stocks like that. We're not looking at that in junior mining. Now, if you're investing in producers, you'll be looking at some of that stuff. But in junior mining, you're not really looking at that those things don't apply. The three factors that apply, and you always start with, are number one, management. A that's the number one criteria in my opinion, because juniors are basically startups. Think about it. They're starting from scratch. They have a piece of land and some people, and they're going to try to make a discovery, right? What you're looking for there is people who have a demonstrated success. They've done this before and they've been successful at it. I'll tell you more about that in a minute. Number two, location is critical. I can't tell you, there's been a number of times where I've had an investment in a geographical area that was the stock bombed because of something that the local government or regulators or whatever, or the social license uh, that happened and affected that company. There's a really bad example. I put it in the book, Pater. You can read about it. But the point is, you have to screen. You must screen for politics because Elon Musk can move his plant, but a mining company can't move the mine. That's where it is. So you have to pro mining jurisdictions. Number three is a project. Why is that number three? Shouldn't that be number one? Well, no, I only look at the project after I look at number one and number two. Because if it's not a strong team and it's not in a pro-mining jurisdiction, I don't care about that drill result. Now, I may miss some, but generally speaking, I'm not going to invest in something like that. Okay, so that sounds good, Jeff, but how do we actually do that? Well, here's some tips that I think that are easy for people to start with. These are in the book, and these are not commonly talked about, but they are things that have been very helpful to me as I've invested in this sector. So, number one, we're going to start with management, the people actually running this company. So number one, look at the past companies they ran. You can look them up. They're public companies. And what you want to try to find is what did the stock do under their tenure? What did the stock do while they were there? Did they create shareholder value? If they didn't, that's one thing to consider. You might end up passing on that because they didn't create shareholder value. And number two, this is critical. How much have they personally invested in their own company? I interviewed a CEO once at a conference and went through the whole thing. And at the end, I asked him, well, how much have you put into this stock? Oh, I haven't invested anything. I'm like, well, what do you mean you haven't invested in your own company? And well, kids and college and blah, blah, blah. And I'm like, I'm sorry, that's a non-starter for me. You want these people to be at risk. You want them to have something at stake. That's critical in my opinion. I always look for it no matter what. Number two is the location. Like I was saying, you want a pro-mining jurisdiction only because you can't move the mine. Your starting reference there, number two, is the Fraser Institute annual survey of mining companies. You can Google that phrase. It'll come up for you. I think 2023 is the most recent, so there should be an updated one coming out real soon. But the reason I like that, and I encourage you to start there, is because that survey is filled out by people working in those countries. So if you want to find out about Ecuador, you'll see that rated in there, and it's rated based on the responses from the survey of people actually working in that country. If you're not working in the country, you can't have an opinion. So it's great. It's firsthand information. It's very good. It's a good starting point. And then number three, the project. Again, I only look at that after number one and number two. You want projects that are like my grandma's chocolate chip cookies, big and rich. That's what you're looking for. You want an asset that's big or can be big, and rich meaning high grade or can be high grade. They must show clear potential to get big. The number one question you're always going to be asking yourself as you go through and watch press releases is, can this project be an economic mine someday? That's it. Because if it can't, there's no reason to invest in it. If it can, great. We can see some major share price appreciation. Okay, I don't want to go on too long, but I had to give you one example of pay dirt of investors that have hit pay dirt with mining stocks. There are numerous examples. The book is full of them. I devoted an entire chapter of this in the book to just examples of investors that have hit pay dirt. I had so many that the editor had to cut it off. Said, Jeff, no more. Okay, so there's many examples, but here's one I really like because this is from the last bull market, okay? 2008 to 2011. So we're just talking about a 3-year period of time, right? There were 141 10 baggers during that 3-year period of time. That is pretty good. Now, we're not going to get all 141, obviously, but what if you got 10%? That's 14. What if you got just 5%? That would be 7. How many of you 5 years from now, or even 3 years from now, would be happy if you had 7 10 baggers in your portfolio? They're out there. We're going to find some of them. You can find some of them. It's definitely possible. This will happen again. We're already seeing it start now. And last, I want to show you this because we've had quite a run in some of the stocks and in gold, right? So I want to show you that it is very normal to see corrections in the gold price in the middle of a bull market. So these are all the corrections from the last bull market, 2001 through 2011. So it's a 10-year, 10 and a half year period of time. And you can see there were 20 of them. There were 20 corrections of 6% or more in that bull market. And you can see on the far right, the average, pardon me, even if you take away the crash in 2008, the average is still 11%. So if at some point you see gold having a major correction, it's down like 10%, okay? You now know that that is normal because that's what exactly what happened in the last bull market. So one thing that I frequently say in the Gold Advisor, the free newsletter, is we have a mantra. We ride the waves, we buy the dips. So when a stock is moving, ride the wave. When there's a big dip, that's your chance to either add more shares of something you missed or buy a new stock or whatever the case might be. That's how you want to handle that. And I just want to tell you about number one. In 2008, I was working for Casey Research, and we put out an alert at the bottom of the market. It was Halloween Day in October 2008. That was the bottom of the market. I think our alert came out the next week. Anyway, and we told people, hey, if you want to speculate, you're willing to take some risk, now would be a time to go ahead and buy some junior mining stocks. And within, I swear, it was like 3 months, 4 months, 5 months, within 6 months, over that period of time, we got a lot of thank you letters from people saying, oh my gosh, thank you. I'm up, I've doubled my money. I'm up 5x. I'm up 10x with some stocks because we bought the sell-off. Unfortunately, Jeff did not participate in that. He was a little scared at the time. I uh, just felt like, wow, this is a little scary. I don't know what's going to happen. I had family that had lost jobs. I just didn't know how this was going to get resolved. Who's going to buy a junior mining stock in that environment, right? They did. They bounced tremendously. That was the beginning of that 3-year bull market I showed you where there was 141 10 baggers. Anyway, so I vowed to myself, look, I'm not going to let that happen to me again. If we see another opportunity like that, I mean, what's going to be worse than the great financial crisis, right? I am going to buy that dip, okay? So COVID rolls around, right? 2020, and we had the big crash there in March of 2020. Everything crashed, including gold stocks. The juniors all just really crashed. And I thought, you know what? The world is not going to end. And I don't know how this will resolve, but I think it will. I don't see a lot of difference between here and 2008. And I loaded up. I mean, I loaded up big time. I bought silver at, I think, $13 an ounce at the time was the spot price. And I bought a lot of mining shares. By September of that year, my entire mining portfolio, not just a few stocks, my entire mining portfolio was up 4x in 6 months. So, yes, I love big dips and I cannot lie, but I really took advantage of that. And the reason I'm bringing that up is because that's what I'm focused on in our newsletters. But I think we're at that point again. It's already starting to happen where these things have been so cheap for so long, and there are still bargains out there. Some of our stocks have doubled or tripled, but there are still bargains out there. You can still find them. And I think we have a similar setup as we did then. We have the Gold Advisor newsletter. That's free. That's that first logo you see there on the left. Below that is Paid Prospector. That's the book. Or excuse me, Paid Prospector is the paid newsletter based on the book. Over to the right, you see Silver Advisor. Peter, I'm sure, mentioned that yesterday. That's a free newsletter as well. That's the book Pay Dirt on the right that most everything is based on. And the things I've shared with you today are basically all out of that book. So there you go, ladies and gentlemen. I hope that was useful.
Jeff, that was awesome. I feel like you covered so much, especially for the I mean, I feel like I want to go buy junior mining stocks right now. And I think I wish I had known you in 2008 as well, because I did not buy that at all. First question, which subsectors of the juniors, gold, silver, copper, etc., do you think is the best bet?
Yeah, I'd say all the above, but we're in a bull market for all of them. The only one that really hasn't ignited, is the critical elements. Some of those have been stagnant, but I'm not, we're in a bull market, but I'm not looking at the bull market. I'm looking at companies that can make a discovery or can prove up a resource or can double or triple a resource, companies that are about to go in production. There's a lot of research on these pre-producers, and I have a very specific strategy in Pater Prospector for that. Um, I think the stocks in those environments, in those scenarios, they tend to rise. Some tend to rise very big. So I'm looking more at a company than I am necessarily looking at, which little sector might be the best. Because if a company makes a big discovery, that's going to pay dividends. And by the way, the reason I say that is because there's been a lot of that has happened like that in bear markets. Even when the metals aren't doing well, that's happened in bear markets. So, but to answer the question directly, I'm focused on gold. Peter covers silver for us. Definitely focused on uranium and definitely focused on copper. We have a couple lithium picks that kind of market's sort of on pause right now. They're good buys, and I think that'll come back because they're critical minerals. They're going to be used more and more. So. But those are the metals that I'm really focused on and the companies within those metals.
Next question, how long do you think it will be before some of the major mining companies participate in more M&A to replace the shrinking resources?
Oh, that's a great question. I'm glad you asked it because at the last conference I think Callie was at, I put a table up there that said I think M&A is coming and coming soon. And it was for two reasons. One was a table that I showed that the earnings and cash flow of the producers. I showed the top six producers, and their earnings and cash flow had increased by double digit and triple digit percentages year over year. There was some M&A in the middle of that, but earnings and cash flow jumped tremendously. They increased more than any other sector. So there's a lot of green on the screen for, producers that are looking to buy ounces, but even Wall Street and Main Street, there's a lot of green on the screen. The second reason I thought M&A was going to happen was because for those of you who've been around a while, back in the peak of the market in 2011, a lot of the producers, a lot of the seniors got a little irresponsible. They started taking on a lot of debt, and it took them a long time to clean up that debt, a decade or more. Now the net debt on a earnings per share basis is expected to be zero this year. So what you have is you have producers, seniors that have enormous cash flow and no debt, generally speaking. That's the perfect environment for them to start acquiring assets. I mean, a lot of us ask, like, what the heck is going on? Why aren't these producers, these companies buying juniors? They could buy five of them for what they could get, one 4 or 5 years ago. And I think that's why they wanted greater cash flow. They wanted a sustainable higher gold price. They wanted to pay down debt. But make no mistake, these guys are going to need ounces. They must replace ounces. If you produce 1 million ounces of gold a year, you have to come up with another 1 million ounces of gold just to stay even. So they need ounces. I do believe that M&A is ripe to take place.
Adrian asks, which are the best industry conferences for retail investors? I feel like we have to say Metals Forum because we're always there.
I have to be honest, like Callie said, Metals Investor Forum is my favorite. It's a little smaller, so it's a little more intimate. So you get plenty of time to talk to speakers, to the companies themselves, to each other, compare notes. It's great. I've met a lot of people there at these conferences. They have four a year, I believe, Cali now. They're usually in Vancouver. The next one is September 26th, I believe. I will be there. I'll be speaking. The other thing to be aware of with that conference as an investor is it's invite only for the companies. So a company can't just pay a fee and show up like they can at other conferences, right? They have to be invited by a newsletter writer. So you have some pre-screening, if you will, that's being done by newsletter writers and analysts. That's the only way they can be there. Um, so I like it. But there's many throughout the year. The Vancouver Resource Investment Conference in January. There's the big granddaddy of them all, PDAC, in March in, excuse me, Toronto. There's the Rick Rule Conference. If someone's interested, I can send you a link. And you can do that one online as well. So there's a lot to go around, and there will be more, I think, as we go through this bull market.
Do you have a specific percentage of your portfolio dedicated to the first pour strategy or an estimation of average?
So what that question is referring to is, so Lobo Tigre and I worked at Casey Research. He was actually my mentor there. So he was trained by Doug Casey. I was trained by Lobo. It was great. We had a lot of fun back in the day. Like I said, it's a different company now, but Lobo went out on his own. I went on my own. But anyway, what he did at the time was he mentioned to Rick Rule, hey, these companies that are pre-producers, they're actually gearing up to start production. Those guys are always seeing a price increase in their stock. Rick Rule says, I think you're right. So Lobo went back and actually did the research, and he analyzed 120 companies. I forget what the number was. Single asset companies, okay? So not a big producer that is about to put another mine in production. This is single asset producers, a brand new gold mine. And the research showed that if you buy the stock when the construction decision is declared, you'll see that in a news release, a construction decision. And you hold until first pour. That's another press release from the company. So on average, it's about 18 months. Uh, the research shows that those stocks typically will double in that time period. Now, that is an incredibly attractive strategy while also being lower risk. As with anything, they're not every single one's going to work out, but most of them do, and some of them work out very well. We have some in the portfolio right now, and I sad to say that they're all in the paid letter, so you'd have to join paid or prospector, but we have three in there right now. Um, how much do I devote to those? The answer to that is, well, it depends how many we have that I would want to buy and therefore pass along to subscribers. Because you don't get dozens of those opportunities every year. You get three, four, five, maybe. Some years maybe only one. I think we're going to gear up because of the bull market. We're going to get more like five or six here next year. So it depends really how many you have. But if it's one that I like and it passes all the criteria and pay dirt, I'm all over it.
Next question. Can you talk about how you manage profit? Do you ride it all the way to the top or you take some profit as you go?
That's another great question, and obviously there's no perfect answer. I do say in the book that one reason I've been able to build my portfolio bigger over time is I always took profits, always. When I'd get a double, I'd scrape a little off, maybe not 50% the whole thing, especially if it's really running hot. Um, in the book, Keith Neumeyer of First Majestic Silver, you may know that name. He was interviewed in the book. there are 17 people in the book, actually, I interviewed as well, that are in the book that on top of the strategy that I outlined. Anyway, Keith in there said, he always takes profits, but he waits until they are up 300%. Sometimes he may wait till they're up 500%, but he did say that he does tend to sell them all at that point, at least, 90% of his allocation in that stock. So that's how he handles it. But I will admit to you, there are some, special circumstances where I've not taken a profit on a double. And that is there's a company in Pater Prospector right now. It's a pre-producer like we were talking about. They've not got to first pour yet, right? But the stock's up like almost 300%. I'm going to wait till first pour is announced because I think there'll continue to be some excitement leading up to that, and the stock will move higher, and then I'll take profits. Sometimes we'll sell the whole thing. Sometimes we'll just take profits if we really like the company. But that's how I personally handle it. And I wouldn't recommend never taking profits. I would always do it at some point, whatever your rule might be. Again, there's a lot of people in the book that are interviewed about that, and they had their own opinion. So.
Stan asks, how long do you expect the bull market to run and based on history?
Another great question. So if you look back at all the bull markets, the length of them varies, pretty extensively. Some are like 1 year, but the average is about 3 years, 3.5 years, something like that. And we've been going for what year? We have a lot more, potential catalysts for this thing to keep going longer than that. Geopolitics, politics, environmental reasons. There's a whole laundry list of reasons why. I think we'll know when the bull market is over, but again, be aware that there will be significant corrections. Let's say the tariffs get resolved and Trump announced, okay, we worked out a deal with everybody. Well, gold's risen to a large extent because of tariffs. It's going to fall on an announcement like that. It's going to decline, but it doesn't mean the bull market is over. There's simply too many other, crisis related catalysts that could ignite. The financial system is not stable enough, especially our debt. So, I could easily see this thing running more than 2 more years, but we'll see. The time is now.
What are the main considerations to take into account when trying to compare Canadian listed companies with Australian listed companies for mining?
Yeah. That's a good question because the rules are similar in Australia, but there are some differences. And I do not follow Aussie stocks because it's very difficult to get there. It's very time consuming, and I feel like I need to be able to see projects if I want to of a stock that I own or I'm thinking about recommending. And that's admittedly a deterrent. And the second reason is that there are some differences in the rules, how they handle things. It's kind of insane, but it's not uncommon for Aussie juniors to have 1 billion shares out. That's hard for me to get around, but that's what they do. So you have to be aware of those things if you're going to invest in Australian companies. I'm not trying to discourage you from doing that. I don't personally follow them. Another reason is because there's so many opportunities here in North America. Why am I going to go halfway around the world when I have opportunities here I can't even keep up with?
What qualities and experience would you look for to identify up and coming CEOs that might become future living legends in the coming bull market?
Great question. We used to have was it Fabulous Under 40 or something list at Casey Research, looking at those up and comers. What I look for, honestly, is honesty and trust. I want to look the guy in the eye, and I want to be able to determine, okay, he's not trying to, pull something here or exaggerating or whatever. The second thing I want to see is if they don't have the experience, do they have a team behind them that has experience? So there's a company in Gold Advisor, I'll just share it, Westward Gold. The CEO and the CFO are on the younger side. Um, but they are backed by some of the strongest geologists in Nevada, where they're focused, that you will find. And they have an incredible geological team. So that's an example of why I might invest in a company like that. But I'm looking for, and what that means, by the way, is that gives them the chance to grow and maybe become, one of the next leaders. I'm not afraid to invest in young people, but I do want to see a team that has experience, successful experience, behind them.
Are there any indications that institutional fund managers might be launching new ETFs or mutual funds in the precious metals mining sector?
Good question. There will be more. I don't really track that myself too closely. I see them and hear about them, but I don't really track it for the simple reason I don't invest in ETFs. The gold I own personally or it's in storage. And this, when it comes to mining stocks, I'd rather pick up myself. Any ETF, you're going to get the bad with the good. Um, there was one ETF, a mining ETF, that tried to focus on earnings, and they did. But the catch is, they didn't make that shift and add that company until after the earnings came out. By then, the stock had moved. So I wasn't, you know, I didn't feel compelled to buy that. But we're in a bull market, and so you're going to see more and more of those. You're looking for, I cover this in the book and tell you what to look for, but you're looking for reasonable, cost share structures. You don't want to be anything that's high cost. You can easily avoid that with ETFs these days. And you want to look at the manager, just like you're looking at a stock, you want to look at a manager of the ETF or the mutual fund and make sure they have, again, not experience, because anybody can write a good resume, but they've had demonstrated success in this sector. If the last fund they ran was marijuana, I'm probably not interested.
Jeff asked, "What's your opinion on titanium?"
Oh, that's an up and coming market. I'm kind of paying attention to it. I'm watching it because I there might be opportunities there. I don't have a primary titanium asset or company in the portfolio at this time, but I'm watching it. That's something that could be coming up.
What are your thoughts with I mean, obviously a lot of the junior miners are here in Canada. What do you think is going to be the outcome with our election and very different, I think, opinions in the US versus here and how that will affect our junior mining going forward? Because there's obviously a lot of cross-border connections.
I think the trend has reversed due to Trump. Like him or hate him, I'm not making a political comment, but I think the trend has reversed from uh, being stingy about permitting to loosening those guidelines up, shortening permitting timelines. And I think that's happening. There's a spillover of that in Canada. We've seen some of your provincial leaders already say they're going to shorten timelines. So I think that's happening there as well. This is a good thing. It makes me feel better in some instances about companies that could potentially have long timelines for permitting. From a discovery to, excuse me, first pour could be a decade. So if you can cut that in half, uh, that's a good thing, as long as it's responsible, of course.
Adrian clarified, so is it the screening tools for your researching stock, is that proprietary? Or or is that just your secret sauce? Is it just Jeff Clark?
They're all in the book. Nothing's proprietary. No, it's all in the book. You know, I got so many questions about how I pick stocks. That's why I wrote the book. So, um, and it's not a long read, and we tried to make it educational. It's, fun at times. There's a free sample chapter, by the way, on the website, and it's the scariest mine I've been in. And you can read it for free and see if it's for you. But I will warn you, if you're claustrophobic, be prepared.
One of the questions he had asked on Monday was about some of the similarities of 2008 and the commodity bull market. You can let me know if it's the same rate or not. But since you did talk about 2008, do you want to compare, like I know with the bond markets, like Peter was talking about that, there's a lot of similarities to what we saw as the crash in 2008 and the commodity super cycle that's
Commodities in general, not just the stock or metals we've been talking about, but commodities in general are, pretty dramatically undervalued relative to almost any comparison, but especially the stock market. So they're poised to move. They've had some very big runs in the past. So I think some good commodity exposure is a good idea. I just personally have my experiences with metals and mostly precious metals and copper and uranium and that sort of thing. So that's why I'm focused on that. That's just what my background is. But I think commodities in general are probably a good thing to own, and that could last a while, that bull run.
what were a couple of your key, this is the dip I want to buy in 2008 that, could have been transformational for anyone that was following you?
Oh, that was stocks that we recommended, and we just said in general, you could buy junior mining stocks here. And I think we might have given a list out or something, but I think that was in the paid letter. But it was just, look, they're so beat up, it's time to buy. And that's kind of the well, that's definitely the situation we had in the COVID crash in March of 2020. And it's the situation we've had about a year ago. They were all in the same situation. And now there's a little bit of bifurcation going on in the market. You have some that are just really running hot, doubles and triples. And then you have some that are still just sitting there. And I think some of those could be good investments going forward. Again, with the idea in mind that we still have at least a couple years to go in this bull market. Um, but that's a similar situation that we've had, and that I think that's partly explains why some of these stocks have really taken off. I do think the sellers are gone, and I do think the fund managers and institutional investors, maybe some Wall Street, those guys are starting to move into this sector. That's why we're seeing some big gains now.
Are you seeing a lot more like new exploration stories as well as the permitting is looking a little easier as we're creating that
That's a
narrative?
good point. Yeah, especially the uranium sector. I've seen a couple companies pop up that are new, that are developing U.S. assets, starting with the fact that U.S. is really wanting to develop uranium projects, and one of which I like so much that we recommended it in Patriot Prospector. We just recommended it. It's a new pick, but I like it a lot.
Jeff, thank you so much for a fantastic webinar presentation, and I'm sure we'll see you again
Absolutely,
soon.
Callie. Thank you for having me. You're a great host, and I hope this was useful to everyone. That's what I really want.